Every second, trillions of dollars move through the financial markets. Fortunes are made and lost in the blink of an eye. But here's the catch. Much of this movement is driven not by cold, hard logic, but by something far more primal emotion. And some of the most powerful players in this arena, hedge funds, know exactly how to exploit this human instinct. In the animal kingdom, moving as a herd offers safety in numbers, a way to evade predators and increase the odds of survival. In the financial markets, this herd mentality, while seemingly natural, can lead investors astray, causing them to stampede into bad decisions. Today, we uncover how this ancient instinct, hardwired into our very being, becomes a tool for profit in the hands of a select few, and how you can protect yourself from being led astray. Join me as we delve into the fascinating and often treacherous world of financial markets, where the psychology of the herd reigns supreme. Deep within the human psyche lies an ancient instinct, the urge to follow the crowd. This herd mentality, honed over millennia, served our ancestors well, increasing their chances of survival in a world fraught with danger. When faced with uncertainty, our ancestors found safety in numbers. But in the modern world of finance, this instinct can be our undoing. The stock market, a complex ecosystem of buyers and sellers, often triggers this primal urge to follow the herd. We see others buying, their portfolios seemingly overflowing with profits, and we feel an irresistible pull to join the frenzy, to become part of the group. This fear of missing out, FOMO as it's known in the digital age, drives us to make irrational decisions, to buy assets at inflated prices, hoping to ride the wave of collective euphoria. But like all bubbles, this too must burst. Conversely, when markets tumble, fear becomes the dominant emotion. We see others selling, panic sets in, and we're driven by a primal urge to escape the perceived danger. This mass exodus, this desperate scramble for the exits, only exacerbates the decline, turning a market dip into a full-blown crash. From the dot-com bubble of the late 90s to the 2008 housing crash, history is littered with examples of herd mentality amplifying both market highs and lows. It's a potent force, one that can lead to both irrational exuberance and devastating panic. In the intricate ecosystem of the financial markets, hedge funds operate as apex predators. Armed with vast resources, they exploit the herd mentality of the market. One effective tactic is the pump and dump. Hedge funds create a buzz around a stock, often with exaggerated or fabricated news. Retail investors, driven by FOMO, pile in, driving the price up. The stock soars to unsustainable heights. Hedge funds then sell off, leaving latecomers with overvalued assets. The bubble bursts, and the stock plummets. Another tactic is short selling. They borrow and sell shares, betting the price will fall. Hedge funds may spread negative rumors to trigger a sell-off. This creates artificial selling pressure, driving prices down. The herd panics and hedge funds profit. The GameStop saga showed the herd fighting back. Hedge funds underestimated retail investors, but their tactics were clear. Our brains, for all their complexity, are susceptible to a range of cognitive biases. Mental shortcuts that, while often helpful in everyday life, can lead to flawed decision-making in the financial markets. Hedge funds, acutely aware of these vulnerabilities, exploit them to their advantage. One such bias is the bandwagon effect, our innate tendency to believe that the majority must be right. When we see a stock soaring, everyone seemingly buying, we assume there must be some underlying truth we're missing out on. This fear of being left behind, of missing out on a sure thing, overrides our rational judgment. We jump on the bandwagon, buying high and often selling low, fueling the very bubble that will ultimately burst. Another bias that plays into the hands of skilled manipulators is anchoring bias. This refers to our tendency to rely too heavily on the first piece of information we receive, even if it's irrelevant or outdated. For example, if a stock once traded at a certain high, we may anchor our perception of its value to that price, even if the underlying fundamentals of the company have changed. Hedge funds can exploit this by highlighting past highs or setting artificial price targets to lure investors into overpaying for assets. And then there's loss aversion, the psychological principle that the pain of a loss is felt more strongly than the pleasure of an equivalent gain. This fear of losing money can lead us to make irrational decisions, holding on to losing investments for too long or selling winners prematurely. Hedge funds, experts at manipulating market sentiment, can trigger this fear by creating the illusion of a downturn, causing panicked investors to sell at a loss, further driving down prices and playing directly into their hands. The relationship between hedge funds and the herd is not always one-sided. In rare instances, the collective power of individual investors can disrupt the established order, challenging the dominance of these financial giants. The GameStop saga of 2021, a seemingly insignificant event in the grand scheme of the financial markets, became a rallying cry for retail investors, a symbol of defiance against the perceived elitism and manipulation of Wall Street. Armed with trading apps, online forums, and a shared sense of injustice, a loosely organized group of retail investors, many of them first-time market participants, took on one of the most powerful hedge funds in the world and won. Their target, Melvin Capital, a hedge fund that had heavily shorted GameStop, betting that its stock price would plummet. The herd, however, had other plans. Through coordinated buying and a refusal to sell, they drove the price of GameStop to astronomical highs, causing billions of dollars in losses for Melvin Capital and forcing it to seek a bailout. The GameStop saga, while ultimately unsustainable, demonstrated the potential power of collective action, of the herd uniting to challenge the established order. It was a stark reminder that even the most sophisticated investors are not infallible, that the wisdom of the crowd, when harnessed effectively, can disrupt even the most entrenched power structures. However, this victory was short-lived. The same herd mentality that fueled the rise of GameStop also contributed to its eventual decline. As the frenzy subsided and reality set in, many retail investors, caught up in the excitement, were left holding the bag, nursing significant losses. In the wild, separating from the herd can be perilous, leaving one vulnerable to predators and the elements. But in the financial markets, blindly following the crowd can be equally dangerous, leading to poor investment decisions and missed opportunities. So how can you, the individual investor, navigate this treacherous terrain, avoiding the pitfalls of herd mentality and charting your own course to financial success? The key lies in cultivating a mindset of independent thought, of questioning assumptions and resisting the urge to follow the crowd. This begins with understanding your own psychology, recognizing the biases that can cloud your judgment. Rather than chasing short-term trends or succumbing to the fear of missing out, focus on the fundamentals. Invest in companies with sound business models, strong track records, and a clear vision for the future. Don't be swayed by the hype, the rumors, or the fleeting emotions of the market. Diversification, the age-old adage of not putting all your eggs in one basket, remains as relevant as ever. Spread your investments across different asset classes, industries, and geographies to mitigate risk and reduce your exposure to the volatile swings of herd behavior. Perhaps most importantly, avoid emotional trading. Fear and greed, the two most powerful emotions in the market, are the enemies of sound investment decisions. Don't let them cloud your judgment. Base your decisions on data, on careful analysis, and on a long-term perspective. Finally, be skeptical. Question everything. Don't blindly accept the pronouncements of financial gurus or the breathless reporting of the financial media. Do your research, think critically, and trust your own judgment. The psychology of the herd is both a survival instinct and a vulnerability. It's a remnant of our evolutionary past, a reminder of our deep-seated need for belonging and safety. But in the complex and often unforgiving world of financial markets, this instinct can be our undoing. Hedge funds, with their vast resources and deep understanding of human behavior, have become masters at manipulating the herd, exploiting our fears and insecurities for their own profit. They understand that markets are not driven solely by logic and reason, but by emotions, by the primal urges that lie beneath the surface. The question is, will you allow yourself to be swept along by the currents of the herd, buffeted by the winds of fear and greed? Or will you chart your own path, guided by knowledge, discipline, and a healthy dose of skepticism? The choice is yours.